All right, now that we've filled every seat, I think we'll get going. Good evening. My name is Jacob Ludwig. I'm a senior in economics, co-chair of the Committee on Lectures, and president of the student body here at Iowa State, and it's my pleasure to welcome you here tonight. We'd like to begin this event with a land acknowledgement. Iowa State University is located on the ancestral lands of the Iowa Nation. The United States obtained the land from the Meskwaki and Sauk nations in the Treaty of 1842. We wish to recognize our obligations to this land and to the people who took care of it, as well as the 17,000 natives who live in Iowa today. We'd also like to start by thanking the co-sponsors of tonight's talk, the Economics Club and the Committee on Lectures, which is funded by student government. A few housekeeping items. There will be an opportunity to ask questions at the end of the lecture. Please note there's a microphone here in the center aisle set up for you to use. Please do not use any flash if you're taking pictures. If you leave before the Q&A is finished, please exit quietly and refrain from talking until you have left the room. Our lectures program student worker will be outside the hall to swipe your student IDs if you're here for class credit. Swiping will not begin until the lecture is finished. Finally, I'd like to briefly announce an upcoming lectures event. On Wednesday, March 22nd, award-winning author, environmentalist, and climate activist Amitav Ghosh will read from and discuss The Nutmeg's Curse, which traces back to the discovery of the New World and the sea route to the Indian Ocean. The story of the nutmeg becomes a parable for environmental crisis, revealing the ways human history has been entangled with earthly materials such as spices, tea, sugarcane, opium, and fossil fuels. The lecture will be at 7 p.m. in the sunroom. All lectures are free and open to the public, and a full schedule is available on the lectures program website. And the Economics Club is pleased to welcome all of you here for listening to our live feed, to the people listening on the live feed and the people here in the room, to the first Carrie and Linda Killinger Foundation lecture on economic fragility by ISU alumnus Thomas Honning. Dr. Honning was born and raised in Fort Madison, Iowa. After earning a bachelor's degree in economics and mathematics from Benedictine College, he was drafted into the Vietnam War, where he served in the artillery. After his discharge, he moved to Ames, where he completed his doctoral research on commercial banking with Professor Dudley Luckett. Dr. Honning joined the Kansas City Federal Reserve Bank's Division of Bank Supervision and Structure in 1973. His career included several challenges that influenced his approach on monetary policy, including the stagflation of the 1970s, the agricultural recession and banking crisis of the 1980s, and the Great Recession. Over that span, he moved steadily up the ranks of the Kansas City Fed, serving as president from 1991 to 2011 as a member of the Federal Reserve's Open Market Committee from 1991 to 2011 as well. Dr. Honning retired from the Kansas City Fed in 2011 when he was nominated by President Barack Obama to serve as a director and vice chairman of the board of the Federal Deposit Insurance Corporation. Since 2019, he has been a distinguished senior fellow at the Mercatus Center of George Mason University. Dr. Honning is known for predicting the rise of banks that were too big to fail 9 years before the financial crisis of 2008, and for criticizing the Federal Reserve's policy of zero interest rates after 2010 as risking inflation. The Iowa State Economics Club is pleased to welcome him back to Iowa State as our first Carrie and Linda Killinger Foundation lecturer, where he will discuss inflation, the Fed's efforts to control an economic monster. Please give a warm Iowa State welcome to Thomas Honning.
Well, thank you very much for that nice introduction, and I want to thank Peter and the staff here for inviting me here to come back to Iowa State. I do so every once in a while. It's always good to be back, and I appreciate very much the turnout here tonight. I know that economics is a study of choice, and I'm told that the attendance here tonight and my audience may be due to a choice that you had to either give blood or come to this, and so you came to this. Is that true? Because I feel less confident if that is true. So I'm going to talk a lot tonight about policy, primarily monetary policy, but also some fiscal policy, since the two are increasingly intertwined. And I'm going to tell it, in a sense, it's not a happy story. but it's very important for you and your generation to hear this story, to think about this story, and to think of the future, because you have to solve the problems that my generation and the generation right behind me has brought us all. So that's what I'm going to talk about here in the next few minutes, and then I do welcome questions. I also welcome anyone to disagree with me. I'm used to it, and I do appreciate it. So let me begin. First of all, this is my opinion, and I tell you this because, in my opinion, the Federal Reserve has adopted a policy. I don't know which one of these, has adopted a policy and a policy framework in which it manipulates, I think that's the word I chose carefully, both the price of money and the quantity of money, expecting better outcomes for economic growth and employment. So the intention is well intended. This policy framework began during the last half of Alan Greenspan's chairmanship of the Fed and was greatly expanded by each Fed chair following him. And he served from most of the 90s into the first half of the 2000s. Under the framework, monetary policy can include zero interest rates, or what's now become known as ZIRP, and unrestricted creation of money through the purchases of government securities and other securities across what's known as the yield curve, or the term structure of interest. And that's known as quantitative easing. The effect of this framework has been to balloon the Fed's balance sheet and commercial bank reserves. The policy evolved as the Fed expanded its focus beyond price stability to financial stability and full employment. It also specifically narrowed its inflation focus to price inflation only of goods and services, ignoring asset inflation, which enabled the expansionary policy to run much longer than it otherwise would have in most economic systems. So what's the evolution of this? The first, in some ways, the most significant change in the Fed's operating framework came in 1991, when I was actually a graduate student here in monetary policy, when the U.S. abandoned having an external discipline. Then it was known as a gold standard, and I don't advocate the gold standard, but it was an external discipline to constrain the government's spending and monetary and interest rate policy. At that point, the U.S. went with a central planning Federal Open Market Committee of 12 individuals with the sole control policy framework for monetary policy. Policy discipline would be self-imposed by this committee, subject to political pressure, and the record is not good, as the Fed allowed itself to become increasingly responsive to political pressure in its management of monetary policy. And I'll talk more about that in a second. The current framework, QE and ZIRP, began to evolve during the second half of Alan Greenspan's chairmanship of the Fed as he became increasingly interventionist. In a Jackson Hole symposium, in terms of central bankers from around the world, he made it explicit that the Federal Reserve would not head off asset bubbles, but would rather clean up the aftermath when they bust. His bailout of the markets became recognized as a Greenspan put, and you should remember that as you read economics. There was an Asian financial crisis that began in July 1997, followed by a Russian financial crisis in August of 1998, and these are examples of his policy path. Again, in early 2001, the U.S. suffered a recession as the dot-com bubble collapsed and the Fed became involved in its rescue. So during the Asian and Russian liquidity crisis, the FOMC lowered the Fed funds rate, or its policy interest rate, from more than 5.5% to about 4.5%. in the first quarter of 1999. It did reverse its rate forward after reaching a high of 6.5% in the third quarter of 2000. But then the so-called dot-com bubble true to the Greenspan commitment to wait for the asset bubble to pop and then to clean up, the FOMC quickly increased bank reserves, that is, the amount of money it was willing to put into the system, and systematically lowered its interest rates to 1%. It was also during this period that the FOMC began telling the market that it would hold to an accommodative stance for what's known as a considerable period, which allowed the market then to begin to speculate without worrying about interest rate increases. So it boosted the economy artificially. The Fed funds rate, which was lowered to 1% by the second quarter of 2004, and was kept there for almost a year, even though the economy began to grow significantly more rapidly. The Federal Reserve's holding of treasuries increased from about $507 billion to $685 billion, or a 35% increase in this balance. And bank reserves more than doubled. So we were pumping money into the economy at a very rapid rate, at least we thought so at the time, at a 35% rate. Today, that is peanuts compared to what we do these days. This practice of keeping interest rates exceptionally low for an extended period of time and increasing bank liquidity contributed to the asset bubble centered around housing and eventually led to what you may or may not remember as a Great Recession in 2008. Following the Great Recession and the liquidity infusion, so-called QE, the quantitative easing, that served to staunch it, the FOMC, rather than cautiously restoring its balance sheet and raising the Fed funds rate toward the neutral position or higher, doubled down on its policy prescription and began massive increases in the Treasury and mortgage-backed security purchases and the creation of nearly an unlimited supply of liquidity into the financial markets. And it systematically suppressed the yield curve and keeping short-term rates near zero. To give you a perspective on this, 2010, when the economy was expanding after the Great Recession, the FOMC only then began its first non-crisis massive injection of $600 billion in liquidity into the financial system. In 2012, so quickly after the $600 billion was injected, it then increased reserves by $40 billion per month and then doubled that to over $80 billion a month through 2013. By then, the balance sheet of the Fed, which took 100 years to increase from zero to $900 billion, was by then $4.5 trillion in size. So 400 years of increase. Then in 2019, before the pandemic, there was a liquidity scare in the market, in so-called repo market, that is borrowing market for hedge funds and equity funds. The Fed intervened once again by purchasing $60 billion of government securities and mortgage-backed securities a month until March of 2020, when the pandemic hit. When the pandemic hit, it increased that purchases to $120 billion per month into the economy. And when the recovery started to occur in August of 2020, it continued to buy $120 billion per month through 2020, 2021, and the first 3 months of 2022 as it tapered down. Thus, from 2007, after it already created, from 2015, after it already created $4 trillion, it increased its balance sheet to $9 trillion. So what were the side effects? What were the unintended consequences? Well, beyond its own balance sheet, the massive expansion of the Fed's framework enabled the federal government to finance its spending through ever larger deficits, relying on the Fed's willingness to grow its balance sheet and pursue zero interest rates for an indefinite period of time. By keeping interest rates at zero and below the natural rate of interest, it encouraged, as intended, speculative investing and increased asset inflation that changed the dynamics of the U.S. economy. I'm going to give you some numbers. Federal government spending, which was a large, we thought, amount in 1995 of $1.6 trillion, by 2019 was $4.9 trillion. Between 2019 and 2020, the government spending in one single year increased 50% to over $6.5 trillion, and it continues at that level today. The gross federal debt that you have to pay for, one way or the other, went from $4.9 trillion in 1995 to $22 trillion in 2019, to $31.3 trillion today, and we have a debt ceiling standoff between the Republicans, Democrats in Congress today. 31 trillion from 5 trillion. The federal debt held by the Federal Reserve System, right, the printing of money part, went from $383 billion in 1995 to $2.6 trillion in 2019 to $6 trillion today. As a percent of the federal debt, the Federal Reserve then went from holding less than 8% of the federal debt to 20% of the federal debt today, and it dominates the Treasury market. When they talk about liquidity crisis, they're talking about the amount of treasuries that the Fed is holding out from the market. Interest rates during that period went from about 6.5% to 2.4% in the 2010 to 2019 period, back to zero in 2020, 2021, in the first part of 2022, and now it's 4.5%, a shock up. The federal funds rate, which was 5% in 1990 to 1999 period, in the 2010 to 2019 period, when all this money was being put into the economy, it was less than 1%. The median price of a home, so the entry into a housing market, went from costing an entrant in a median price of $138,000 in 1995 to just over $460,000 in 2022. Now it's coming back down because of higher interest rates. The stock market went from $4,500 to $32,000. So that's how much wealth was added in terms of paper wealth into this economy of ours. And most of all, labor productivity fell from about 2.2% in the 90s to 2.5% in the 2000s to less than 1% today. And the thing to remember about productivity is the only way you really increase the wealth of a nation is real wealth. The goods and services that's produced is through increases in productivity, and it's going the wrong way. And real GDP fell from over 3% to less than 2% to around 2%. And we'll see what happens in the next decade, but there will be many challenges. The Fed's zero interest rate policy and quantitative easing has reshaped policy expectations themselves. The Fed has come to dominate debt markets as it has stepped into bailout markets time after time, and in almost every economic slowdown or crisis over the last 2 decades. So if there's a crisis, the expectation is the Fed will take care of it. Creditors don't have to worry. It has enabled the government to fund its ballooning debt at low rates and has facilitated its massive spending initiatives. The exceptionally low rate below the natural rate has encouraged large-scale speculation in the financial markets and has been the source of asset inflation that I talked about earlier. For all its intervention, however, the U.S. has not seen a systematic acceleration in real growth. So where all these dollars that were created, growth has not increased at all over the long term. So let's look forward. Let's look to your future. The Fed says that controlling inflation is now its primary objective, and it has said this repeatedly. And if anyone took the time or was able to watch the testimony of the chairman of the Fed today, you know that he reiterated that. And though he thinks disinflation appears to be showing its presence, it is nowhere near ready to declare victory. We still have inflation that is well above the 2% target. If you look at the CPI, it's still well above 6%, and that is a tax on the public. Inflation is a tax, and it's a very regressive tax, since it reduces your real income and your spending power. So Jay Powell has said that he is taking a so-called Volcker-like approach to policy, and for those of you who don't know, Paul Volcker is the chairman of the Fed who broke the back of inflation the last time we had it up to 14%. But it was very costly. If he does this, rates will remain elevated, and the Fed's balance sheet will be reduced systematically, taking liquidity out of the system, almost guaranteeing us a recession. But making these bold statements is being done in the face of major impediments to his policy goals. The federal government's spending commitments and borrowing needs forward continue to expand enormously. The federal government still spends over $6 trillion. I used to say billion, but now we say $6 trillion per year, and will do so well into the future. It's set in stone. It may run trillions of dollar deficit in perpetuity, given current political conditions in this country. And finally, the Fed will come under enormous pressure to help fund these deficits to keep the market liquid and keep the government's interest rate costs contained. If the Fed stays with its policy commitment, actually, though, to raise the Fed funds rate and to shrink its balance sheet, the government's borrowing costs will tend to be higher and put additional upward pressure on the cost of borrowing in the private sector. This will almost certainly guarantee the recession that everyone keeps talking about and yet has yet to see. The Fed is, in its own way, at a proverbial fork in the road. Over the past 2 decades, it has established a Fed funds equilibrium for the entire economy around zero. Anytime you move from one equilibrium to another, it causes dislocations. The government and the markets have come to expect compliant Fed willing to purchase government debt and satisfy financial sector's liquidity needs to fund that debt. With the outbreak of price inflation, it has finally forced the Fed to modify its policy. However, aggressive as it might appear, policy remains, relatively speaking, only mildly restrictive. Real interest rates, that is, if you look at the CPI and you take the interest rates that the Fed is charging, we still have negative rates. If that continues, then the Fed is still in an easing policy. Moreover, the Fed balance sheet remains bloated. It's still over $8.5 trillion in size. And under these conditions, the Fed must certainly tighten further to avoid inflation. The question then becomes whether under mounting pressure, should the Fed once again employ zero interest rate and quantitative easing to save the budget and the spending, can it stick to its policy goals? With the CPI inflation at 6.5%, people say it's declining, but as we saw in January, it reemerged. Inflation reemerged as a continuing problem. It's not going to be easily solved. So it brings up a couple of risks that we all face. The first risk is that the Fed is aware that the market is skeptical of its resolve to keep interest rates high and shrink its balance sheet, because it knows it's going to cause a recession. To regain its credibility, it has messaged that it will accept a recession in order to get back to 2%. In its zeal to show its commitment to this goal, it may, in fact, raise rates too high or keep rates elevated too long, and it may shrink its balance sheet at all costs, destroying demand, undermining consumer and business confidence, and discouraging investment. If inflation would decline more quickly under those circumstances to 2%, which would be good, the cost could be a deeper recession, higher unemployment, and loss of jobs and income. And if you were watching today, certain members of the Senate were hammering away at him for causing unemployment to rise. This outcome is possible, and it will put enormous pressure. So it introduces the second risk, which concerns how the Fed will react to political and public pressure that comes with a likely economic recession or slowdown. The Fed says repeatedly that it's committed to bringing inflation down no matter what. However, as the economy slows and unemployment increases, politicians, as we saw today, if you watched, Wall Street, which is always wants lower interest rates, and the public will press the Fed relentlessly to ease policy, even if inflation slows and only slows modestly and continues above the 2% target. The Fed's pattern for 2 decades has been to give the groups what they want. There's no policy rule to follow. They have only themselves in terms of the discipline in the market, and the pressure will be enormous. And in each case over the last 2 decades, they have caved. And I think the likelihood of them caving again is reasonably high. If that happens, then we will have a reemergence of inflation, a loss of confidence in the economy over time, and they will have to go through this exercise once again, as they did in earlier decades. So how does the Fed and how does Congress address this problem for your benefit? First of all, the 2 houses of Congress have to finally discipline themselves. If you increase spending by 50% in 1 year, what's going to happen? You're going to get inflation. What did happen? We got inflation. They continue to spend over $6 trillion a year, and at this rate, with the deficits growing over $1 trillion a year, $1.3 trillion this year, the interest on the debt will be the second or third largest expenditure in the government's deficit after entitlements and defense. If that continues, then our ability to solve the problem will become enormously more difficult. So now they have to come together and say, what can we cut out of the government deficit? And if we have to raise taxes, what can we raise that has the least negative impact on the future growth of the economy? At the moment, they're not doing that. At the moment, they're fighting with one another over how much to spend or how much not to spend, and there's no compromise. The last time we had this challenge, having learned the hard way with 20% interest rates, the Congress did come together, both parties. And by the end of the 90s, the U.S. was running a government surplus rather than deficit. The point is, it can be done. If you are going to have a high standard of living in the next generation, they have to do it again. And I think when you deal with it, you have to deal with it in terms of they've got to come together. They have to solve the problem, or you will be the ones paying the piper. So those are the things to remember as you study economics. It is a matter of choice, isn't it? And we are at a point where we have to make a choice again. If we make the wrong choice, we will have inflation, again, of well above 9%. The last time we reached a peak, it was 14%. If you look at other countries that have had massive inflation, it's gone to 20 or 25%, and their standard of living plummets. There are no free lunches. That's the one thing you can remember about economics. So on that happy note, but on that encouraging note, for you to take action, and we solve this problem, I'll stop, and I'm very happy to entertain questions or very happy to be challenged with my rather dismal outlook. Anyone? Right here. I think they want you to use a mic.
So why doesn't the Fed put pressure?
I'll repeat the question if they don't.
So why doesn't the Fed prevent the bubbles instead of just letting them pop?
It's a good question. Why did the Fed? Because it is very. Every country learns this the hard way. When interest rates are very low and asset values are rising, those who hold the assets are very happy about that. And they don't look at the long-term consequences. They look at the immediate. And as a result, we tend to put pressure on the Fed to say, well, we don't have price of goods and services inflation yet, so why don't we let this ride? And the bubble goes. Finally, when they get the price inflation, which is inevitable, then they raise the interest rates and everything comes down. And why we don't learn that from experience, it's hard for me to answer that question. Political pressure, everyone wants to be popular, and we have no external discipline. We used to, but we no longer have any extra. So now it's easy to, as they say, kick the can down the road, and that's what they've done several times. So unfortunately, that's an issue. We need a rule, in a sense, constraining monetary policy. We don't have it. Yes.
You had mentioned that the Fed is sitting on $8.5 trillion balance sheet made up of government bonds, basically.
Bonds and mortgage-backed securities.
And a lot of those they purchased at zero interest rates, and if they were to turn around and try to sell that and reduce their balance sheet, they'd end up taking a loss, right?
Correct. Absolutely.
And so can the Fed take a loss? And to what extent is this huge balance sheet with now underpriced assets preventing them from doing some of the sort of monetary policy that you think they ought to do?
Well, there's nothing preventing them to do, first of all, the last part of it, there's nothing preventing them from doing the monetary policy that they need to do, in my opinion. Now, the fact of the matter is, if you know, anytime you hold a long-term bond and interest rates go up, the bond plummets. And at the moment, the Fed is taking a $2 billion loss to its income every month right now, $2 billion loss in their portfolio because they hold these very low yielding bonds. And guess what? As they raise interest rates, they have to pay interest on reserves that are more than double what they're earning on the bonds. So they are already taking a loss. They could write that stuff down and they would take immediate loss, but they don't have to do that. Now, how do they book the loss? Well, bankers would love to be able to do this, but they can't. So what the Fed is allowed to do, because it is a central bank and it does print its own money, it books what's known as a deferred liability, and that's an asset. So what they do is they say, yes, we're taking a loss now, and we're not going to remit to the Treasury, but we know that in time we'll start earning money again because these bonds will mature and roll off, and we'll get more higher yielding bonds. So we'll just wait. And every month we write $2 billion off and we increase our deferred liability as an asset, and our balance sheet balances. Now, if Jeff did that, who's a banker, or was a banker, now we would put him in jail. However, since we're the central bank, or they are, they merely record it. And in time we'll grow out of that loss position. So that's how they do it. And now, just so you know, it isn't fair because the banking industry, who also was encouraged, I'll use my words, encouraged to buy out the yield curve, or encouraged to buy bonds that yielded 2%, a magnificent 2% when things were zero. The industry now reports unrealized losses of $680 billion. Unrealized losses. Now, they don't have to take that into their, well, not all the banks have to take that into their income stream because they're holding them as held to maturity, which kills their liquidity. Because if you sell $1 of hold to maturity, guess what? You write the whole portfolio down. So if the industry did that, they'd have basically a $680 billion hit to their income stream, which would be very difficult to swallow. So you asked a good question, and you're very fortunate if you're the central bank. If you're anyone else, you're in trouble. So that's the end of that. Any other questions? Yes.
First of all, I really appreciated your talking about the decision to stop paying attention to asset price inflation. I've been really intrigued by that. I know in the 1920s that it was a concern, and of course it led to a depression because they tried to stop the stock market from going up.
Right.
But it strikes me that, and I'm trying to connect the dots here, but we have a group of friends on the south side of Chicago who argued that there are no asset bubbles. And I'm wondering if that's why Alan Greenspan and others argued that there's nothing to go clean up, and they wait to see what happens.
Well, first of all, let me just tell you, raising interest rates when the asset values have appreciated is not where the bad policy is. The bad policy is having interest rates 1% or less. So that's what they ought to be chastised for, but no one is, because, oh my God, look at the stock market today, and that's what happened in the Great Depression. That's what happened in earlier periods. And in Iowa and other parts of the nation, in the 70s, we had an inflationary period, very significant over that decade. And in 1980, they raised rates as high as 20%. Now, if you had debt and there was any kind of variable rate on it, your cash flows just disappeared. And so you had an implosion, and people lost. We had a crisis in farmland. We had a crisis in commercial real estate. We had a crisis in homes. It was a terrible mess. So my argument was there are things such as asset bubbles. And I can tell you, when you go to 1% or less than 2% in a policy rate, you're going to have asset bubbles. Now, I may not be able to tell you exactly which asset's going to appreciate more, but we're going to have an asset bubble. And when the interest rates rise, we're going to have a correction that is going to be very costly. So why they did that, I think it was because they didn't want to. It was easier to say, well, we'll just target prices. Everyone agrees that inflation prices are bad, so we'll take care of it that way. And I think it's just it's irresponsible for a policy group like the Fed, who should know better, to let that continue. I just read an article. Iowa farmland is now at historic highs again. Inflation is good, and where do you put your money? You want an inflation hedge. Real assets are an inflation hedge. And we'll do that until interest rates get so high that you can't finance the cash flow off it. And we'll see what happens then. So I just don't understand, and I didn't, when I disagreed with the majority of the Fed in 2010 as they went to zero, it was because I knew what was coming. It takes time. The crisis of the 80s actually began in the mid-60s. So economics is not chalk on a chalkboard. It's slow, it's more glacier, and as glaciers take entire areas apart, so does bad policy. And that's unfortunate for all of us. Yeah. Question?
So if I can change topics to
Sure, of course.
So we have a lot of young people in the room getting ready to enter their careers.
Uh-huh.
And your reputation, it sounds like, has been to go very far in the Fed while still remaining not being as scared to rebel against the trend, and vote the way you think things should go. So what advice would you give to young people entering corporations or whatever environment they decide to go to? How to balance two extremes, insubordination to the point of being fired, to being completely passive and going along with whatever the trend is. How did you balance that throughout your career?
Well, it's very difficult, and I can't, there's no formula at all. You have to know, first of all, you have to know where you are and what the environment is. And you have to be able, the key for you, if you have a choice, you have to be able to think far enough, you have to be able to see far enough out to say whether you want to live with what you think are the expected consequences should you go along. Or do you want to say no now and do it in a respectful way, but it will hurt your career, you think? But you know, it's your integrity, it's your choice to make, and you just have to make that choice. Now, some places want you to voice your view and disagree, and if you do that and they don't agree with you, then you accept it. When I disagreed with my colleagues in many 11-to-1 votes, I did so respectfully. And I said, here's why I think it, here's what it is, and I will speak out against this policy, but I understand. Now, I think actually if I could have been fired, I would have been, but I couldn't be fired. I had a great board of directors supporting me, but that's what you have to kind of judge your own circumstances and your own tolerance for how much you can take and your understanding and your feelings about compromise rather than caving. And that's, I don't have a formula for that. My situation was I had lived through several crises. I had seen what will happen, what could happen, what likely would happen. And so when I had to face it, here was my choice. Go along. I probably could have got a better job when I left. Who knows? But my point was, I know what this policy will do. I'm confident of it. And there is no way I'm going to have my name associated with this policy in history. And that's what I did. That's what I chose. But others didn't. And they're doing fine. I mean, it's not the end of the world. But they're wrong. Now we know it. So happy days. So any other questions? I'm happy to take them.
So you mentioned the lack of external constraint on the Fed as
Yeah.
being a major problem, and that an external constraint would be helpful. What kinds of external constraints would you recommend?
Well, I would not go back on the gold standard. It's a very harsh constraint. I realize that. But there are rules. There are ways that you can. There's a there's no rule that's perfect. There's nothing, but it's a guide that puts pressure on that committee to say, wait, we're getting way away from the rule. Now, one example, it's only one, there's others you can come up, is what's called the Taylor Rule. Anyone in monetary policy knows what it is. And it says there's a relationship between unemployment or employment and real growth, GDP growth, and here's what it is, and if you want this amount, here's the trade-off. And what that showed in the period of zero interest rates, it showed very clearly interest rates should have been much higher. But it wasn't a rule that anyone had to follow, so no one did. That was in that policy framework. So what you would have to do is legislatively, or the committee itself would have to adopt, although it would be dropped as soon as they had to. So it would have to be done legislatively that says you have to follow a rule. And if you're going to deviate from it, you have to have a clear explanation to the Congress of the United States before you allowed it to go on very long. So you could do it in that manner. I would say, otherwise, if you don't have a legislated rule, you don't have a rule. That's the problem with it. And I think that's why we are in this situation today. And I really am worried about the future and the test will be when interest rates get up to 6% or more and the economy really starts to tighten down. And in fact, I mean, I watched this hearing today, and one of the senators just saying, you know, and you can feel it. I mean, if you let unemployment go, it's 3.4%. If you let unemployment go to 4.5%, you will put 2 million people out of work. How can you do that? That's irresponsible. How can you do that? People out. Well, the answer is, you're right, it's terrible. But if we don't do something, if we let inflation reignite to 10% or 14%, then we'll have 15% unemployment. So like the lawyer said, pay me now or pay me later. The mistake has been made. I can't go back and undo the mistake. But if I go forward and don't address the mistake, I will have a bigger mistake down the road. And that's hard for people to understand and appreciate. I know that because you're thinking 2 million, but think about 5 million unemployed. And look at the Great Recession. We had 10%, almost 11% unemployment, tens of millions of people unemployed. So that's what you have to be able to, that's what the FOMC has to be able to explain and stand firm, or we will have, and I tell people to study Argentina. At the turn of, from the 19th to the 20th century and into early part of that, its GDP was rivaled ours. Its wealth rivaled ours. And then they went on a, shall we say, spending binge supported by printing money. And now they're a third-rate nation. I mean, that's just the hard facts of it. And, you know, you cannot achieve success by just printing money. So, any others?
I come from an agricultural background. Most of my family on both sides were involved in farming during the 80s farm crisis.
Yep.
And luckily, our families were both ones who never borrowed a lot of money, so we're in pretty good shape compared to others. There are a lot of young people who got out of high school and college. They got heavily financed, and they got washed out in the 80s.
Yep.
I was farming with my dad in the 90s, but prices were so poor that I had to leave farming too. And eventually the farm got gobbled up by a bigger neighbor. And there are a lot of people, I've been involved in ag policy since the 90s in many different organizations, and there are many people who believe this was all planned to get rid of small family farmers so large corporate agriculture could take over. And that's exactly what we've been seeing in recent years with all the dairy farmers going out all across the upper Midwest. I grew up on a dairy farm. I know what's going on. We have a large dairy processor here in Iowa who's part owner of a 20,000 head dairy herd in Iowa. So they don't have to buy milk from family farmers. They can get it from their own operations.
Sure.
That's what they're doing. I want to know when we're going to have economic policies in place at the federal level, the federal farm policies that support family farm diversified agriculture and bring it back to the way it used to be.
Well, I'm going to tell you the truth. You're never going to see it back the way it used to be. First of all, there's too many economies of scale with farming, so it promotes large farms. Second of all, agriculture, like other areas, is heavily subsidized, and if you want to help a large corporation, you subsidize the industry. The same thing happened in banking as well as agriculture. So now, what you need to do, if you would have to have other limits that would have effects in terms of ability to buy farms and who could buy it, and that would interfere with the property rights, and you'd have a whole nother situation to develop. So the fact of the matter is, I think you've been harmed also by the very policy we've been talking about. Zero interest rates, or very low interest rates, promotes consolidation. It promotes consolidation. Because if I can borrow to acquire something and get a return that is as good as investing in plant and equipment, I will consolidate. And that's what zero interest rates give you. So we have had a policy of zero interest rates that has promoted consolidation. We have had subsidies that has promoted consolidation. And You try and get rid of those subsidies, good luck. You think those corporations are mean, you wait till you take away their subsidy. So, yeah, we're not going back. Now, just so you know, I come from a farming family. My family settled in Iowa in 1851. We have the same farm in the family. My cousin farms it. And like you, debt was absolutely prohibited. And they have a large farm, and guess how they did it? Marriage. And that's the truth. So I don't have, we're not going to go back to the old ways.
There's research that shows those economies of scale are false, that they're manipulated. And I went and worked in the agriculture industry, and I know they gave breaks to people merely because they were larger and they wanted their business, that they weren't given to other people.
Well, you know, if you want to talk about oligarchs and you want to talk about that sort of thing, crony capitalism, that's what you're talking about. I don't, you know, I don't know about it, but I will tell you this, economies of scale do exist. Because at the turn of the century, not this century, the 19th to the 20th century, there were how many people in agriculture? And at the end of that century, how many people were in agriculture? That wasn't because a large corporation taken it, that's because there's economies of scale. I can't undo that. However, parts of it, just like in banking, that is brought about by subsidies, as we talked about, well, that's unfortunate. That's what you have representatives for. The Fed can't solve that problem. Well, the Fed's contributing in terms of zero interest rates, but as far as subsidies and so forth, the Congress makes that available. And I've given speeches across this nation, and they say, well, we have to take care of the debt. And I say, yeah. Why don't we cut the subsidy out why don't we make the Social Security age 70 instead of 67? Oh my God, we can't do that. What about subsidies? How about right now? How about green energy subsidies? Oh my God, we can't do that. So we spend, and then we don't pay for it. We borrow. That's the next problem. So rather than solving a problem, we create a problem. Agriculture is just one of the victims.
I have some questions from our live stream.
Sure.
The first one is from Brittany. It moves a little bit away from monetary policy as well. She asked, is there any sector that sticks out to you that we should look to increase taxes on?
Increase taxes? Well, if you wanted to find something you want to decrease the supply of and tax it. So I don't know which sector you want, but if you have a favorite, pick it and tax it. That's the only way. I mean, now, you have to have taxes in order to run the government, right? So, but you want to make it as painless as possible for everyone. Taxes should not be a punishment. It accomplishes nothing. So I think, look at what's the facts? We have a challenge. 2/3 of our budget, 2/3 of our spending budget is Social Security, Medicare, veterans benefits, 2/3, and they're indexed. So that's part of the reason it's going to go up. 1/3 is discretionary, and of that, a big part of it is defense. In today's world, I wouldn't cut defense too much, let me tell you, because we have some real challenges ahead. And then the other part's interest rates. So we better do some thinking about what we spend money on, because if you try and tax it all, you reduce productivity, you reduce the wealth of the nation. So anyway.
Thank you. We have another question that was Jerome Powell stated repeatedly that inflation was abating. Was he trying to talk down inflationary expectations, and can you talk down inflationary expectations?
You sure as heck can't talk down inflation. Once it's embedded, and it is embedded right now, it takes hard policy to bring it down. Now, Jay Powell is serious about wanting to bring it down to 2%, but he hates to be chastised for the 2 million that might be unemployed. He talked about disinflation. we have seen some disinflation. It's following a pattern very similar to the 70s, where you get disinflation and you start talking about easing up on your policy, and then inflation shoots right back up. That's the risk that he runs. He knows it, but we'll see how he does. It's his burden right now.
And we had one more question.
Sure.
And it was just simply, are we in stagflation?
No, we're not in stagflation. With 3.4% unemployment, stagflation is not an issue. Could we be in someday? Yes, we could, if we don't get this thing taken care of. But no, we're not in stagflation at all. And I think, I think unemployment will rise once the economy starts to slow, if interest rates continue up. But if we then have both inflation that isn't coming down towards the 2%, and we have unemployment rising, then we'll have stagflation. But it's not here now. Any others? Time for one more? Going? Yes, sure.
So Neil Kashkari at Minneapolis Fed
Yep.
has argued back in 2014, 2015, somewhere in there, that we should raise interest rates to a higher level purely because it gives the Fed a greater margin with which they can play with the federal funds rate.
Yeah.
Now, do you think, from your experiences on the Federal Open Markets Committee, that there is a natural high level that the federal funds rate needs to sit at, from which we could operate, or is it just it needs to go higher? Is it imprecise?
I know Neil well. No, he's not right on that. However, interest rates cannot be zero. That's not, think about it. Do you know any good that trades well at a zero price? I can't think of any. So why would money trade well at a zero price? So zero is not the number. There is in economics, and I'm an advocate of it, there is, I can't observe it, but you can't observe most things, a natural rate of interest, which means savings and investment, they balance out. You got external factors, but it's a natural interest rate. You should try and stay around that natural rate. And you make estimates of it. So it's not perfect, but let's say it's 2.25%, 2.5%. So we should have rates. But what Neil is saying is you need to have rates up so that when there's a recession, so that real interest rates are positive, so that when you have a recession, you can lower the rates and make real interest rates negative, which is very stimulative. And my answer to that is the economy is smarter than that. When you lower interest rates, even if they're modestly, positive, you still are able to run that economy, and you have a price on money. So I don't buy that. I do buy we can't have zero, and I do think 2.25%, 2.5%. Once we get inflation back under control, is the right number. And my rule was that if you estimate over the long run, not a short-term number, a long-run number, the 2.25% is your number, then you should have a cap. Say the FOMC cannot raise rates above 4% and cannot lower them below 1% for a period of time, and without going to Congress and explain yourself. And I don't know if I'm getting permission's the right number, because they give permission. So, but you could do that, and that would be your guide. It would be something you have to explain yourself out of, but we're not going to adopt that either. But certainly, he's right that rates have to be higher than zero, but not because you want to bring them down to negative when you get in the mood. So, okay. Thank you all very much. It's been a great pleasure to be here in Iowa State again.
We do have materials for a reception back there, and there's a lot of people in here. So what I would like is for the people in the last row to stand up, push your chairs forward, or pick them up nicely and put them forward so we don't scratch the floor, I guess. And then I think we'll be able to give everybody a chance to get at the refreshments and so on. A reminder that if you need to scan your card, that's going to be outside here. And if you want to meet with